Hi friends, we are starting a face-to-face offline batch in Bangalore with SS Academy. That is for CA Final Financial Reporting paper number 1. Yeah, we'll be taking exactly 2 months from 1st November to 31st December. We'll complete it. It is starting from 1st November 2022. Yes, and in Jayanagara branch of SS Academy, we have morning batch and evening batch will be at Seshadripuram SS Academy. Right, and if the student is missing because of any reasons, right, they are going to get a backup class. All right, we'll ensure that their things, they will study and complete, and from the face to face batch, the benefits out of it. We'll be completing the syllabus in time. You don't need to postpone and you don't need to compromise for your goals. See you in the class. Please share this information to your friends. That will help me and as well. Thank you. Next, for my books, that is an Ind AS made easy, our financial reporting made easy, and fast track summary book. Yes, you can order in ravikanthmiriyala.com, or you can contact the given number for the books. Right, for your doubts, clarification, please join the Telegram group Ind AS discussion group RKM. These charts are from my book, that is quick revision fast track chart book on financial reporting, which you can place an order from my website, that is ravikanthmiriyala.com, or you can purchase it from the market. Yeah, let's look at Ind AS 19, that is employee benefits. Yeah, see, Ind AS employee benefit means any employee, that he may be full-time employee, part-time employee, casual employee, any kind of any kind of employee. He may be MD also. Yes, he's going to be part. The benefits may be directly paid to the employee, or it may be paid to the dependents of employee. It may be for the purpose of the employee family, or it may be paid to the trust, or it may be paid to the directly insurance company. It can be any sort. But except Ind AS 102, that is actually share-based payment. Share-based payment is also an employee benefit, but since there is a specific standard for that, it will be dealt by Ind AS 102, which the revision will be available separately. Right, so all sorts of consideration, all sort of things. Yeah, this discussion, it is actually happened in 4 topics. One is short-term employee benefits, long-term employee benefits, post-retirement employee benefits, and the termination benefits. Short-term employee benefits, in the sense, employee worked in the current year, where the payment will be happening within 12 months from the balance sheet date. Long-term employee benefits, in the sense, employee worked in the current year, that means it accrued in the current year, where the payment will be happening not within 12 months, after 12 months from the balance sheet date. Remember, long-term employee benefit means you will be paying to the employee when he is in employment. Right. Next is post-retirement employee benefit. Employee worked in the current year, like a gratuity, he worked in the current year, the benefits accrued in the current year, but the payment will be taking place after he retired from the employment. Right. And the last one is termination benefit. Termination benefit is not because he worked in the current year, because he accepted to leave or he is forced to leave. The entity forced, that is retrenchment. You asked him to leave under, because he is leaving the entity, not because he worked for the entity. Because he is leaving the entity, we are paying him. That is called termination benefits. Okay, that is called termination benefit. Let us look at the short-term employee benefit. Short-term employee benefits are nothing but salaries, wages, and all other general normal employee benefits. Salary, employee welfare expenditure, those things. Okay, short-term employee benefits are, as I said, which is going to be paid within 12 months from the balance sheet date. That's why obviously no discounting is supposed to be done. The next question should come, where should I hit this? You have to debit it to the profit and loss in general, unless until if that employee worked for the construction of a property, plant and equipment, or maybe investment property, or if that employee is like a scientist, something, scientist or engineer who worked for the development of an intangible asset, then his emoluments, that means his salary expenditure, is going to be capitalized with the respective asset. Otherwise, normally this employee benefits will be charged to profit and loss. Let's get into the subtopic of leave encashment. Leave encashment, leave encashment we will divide into like accumulating, non-accumulating. When I say non-accumulating in the sense we don't pay any extra payment at the same time. I mean, we don't give him one extra holiday also in the future. That means, I mean, if he works here in the current year, if he works for more than his, I mean, he's supposed to work for 300 days, he worked for 310 days. Our 10 days is waste, I mean, for the employee. That is a benefit to the company, but it is a waste to the employee because he is not going to get money and he is not going to get extra holiday also. Right. So that's why there is no accounting is supposed to be done, because company does not have any obligation to pay him, obligation to compensate him. Right. Accumulating can be happening in two ways. One, we may be providing him, right, one I will say vesting, non-vesting. Vesting in the sense we will be paying him in cash within 12 months. Current year, right, his leave, I mean, he has got 30 days of leave, but he took only 20 days of leave. That means this 10 days of leave, 10 days of leave amount, we will be making payment within the 12 months. Right. Under that circumstance, yes, how much he is eligible to payment, that you are supposed to make a provision in the current year. Correct. Now, employee benefit expense account debit to payable. Once you make a payment, payable account debit to cash. Right. Non-vesting in the sense we don't make a payment, but we'll ask him, are 10 days you enjoy in the next year. That means, but that you have to enjoy within 12 months. If you say you can enjoy any time within the employment, if you say like that, then it will be forming part of long-term employee benefit, because we are under the topic short-term employee benefit. He should take the leave within 12 months. Within 12 months only has to take the leave. Right. So that's why what are you supposed to do? He worked in the current year more number of days. That's the reason. First, you should book the employee benefit expense account debit to provision, we should say. In the next year, when he takes the leaves, then provision account debit to employee benefit expenses. You are supposed to reverse the same journal entry in the next year. Whether he avails it, whether he does not avail it, that is his problem. Because if he does not avail, that is his issue. Correct? Now, company is not liable to pay him in any fashion. Okay, right. Next, in this concept, in general, companies follow LIFO basis. LIFO basis in the sense last in, first out. Last in, first out in the sense opening balance number of days are there. Right. Next, current year leaves will be added. Right. Now, current year he will avail the leave. Current year availing leave, we will consider it. That means whatever added in the current year has been utilized, not the opening balance is utilized. That is general understanding. Right. Next subtopic is profit sharing bonus. Profit sharing bonus plan. That means as per this plan, employee will be getting a profit share. Right. He is not a owner. That's why this profit, if you give it to employee, that is going to be charged to P&L only, but it will not be debited to retained earnings, because it is not a dividend. It is not a payment to a shareholder. It is not a payment to shareholder. Correct, na? Right. You see what is how many people are expected to be entitled to get the profit share, and what is your formula? I mean, what is is it after tax or before tax? How to calculate? Because you have to look at the plan. Accordingly, we are supposed to decide that. Let us look at, the next topic. Topic number 4, that is termination benefits. Termination benefits, as I told you, because these benefits are given to the employee because they are leaving the entity, not for the serving purpose. It may be one is you are accepting for the voluntary retirement, or it is the retrenchment where you ask to leave, that's why you are leaving. So voluntary retirement, this termination benefits immediately will hit the profit and loss. Termination benefit expenses account debit to cash or payable, whatever you say. If it is payable within 1 year, obviously no discounting. If it is payable after 12 months, after 1 year, then you are supposed to discount. Remember, in the standard, whenever it is payable after 12 months, discounting wherever you listen, that is always only Government of India bond yield rate. Government of India bond yield rate is only supposed to be taken for discounting, and for unwinding, obviously, as usual, it will be treated as finance cost. Yeah, the finance cost here, that finance cost will be in the standard, only in the standard. That finance cost also will be part and parcel of employee benefit expenses. It will be part and parcel of employee benefit expenses. Okay, that's it. That is one small topic. Next, topic number 2, which is post retirement or post employment benefits. Post employment benefits, which are like gratuity, provident fund, pension, these kind of things are post employment benefit plans, right? So these employment benefits are going to be classified into two. One is defined contribution plan, the other one is defined benefit plan. Defined contribution plan, defined benefit plan. Defined contribution is small and simple. We'll close it. I mean, when I say defined contribution plan, the company responsibility will be over when you contribute to the specific fund, like a provident fund, pension fund. If you make the contribution, my job is over. That means the company does not have any investment risk. I mean, we invested, where the money will go up or down. No, we don't need to care. And we don't have any actuarial risk. Actuarial risk in the sense, I mean, have I contributed correct amount or less amount? I don't need to care about it. But wherein with respect to defined benefit plan, the company promised an agreed benefit. Agreed benefit in the sense, like with respect to gratuity, we'll be giving for every completed years of services, last return salary in 225 days. I mean, your calculations are there, correct? So that agreed benefits are there. Here, yes, the company has investment risk as well as actuarial risk, because there are so many number of variable components. Like, we don't know what will be the last drawn salary of this guy. We don't know how many number of completed years of service this guy is going to provide to the company. We don't know many things. That is the reason defined benefit plan, it requires a lot of estimations, many things are involved, right? With respect to defined contribution plan, it is like almost like short-term employee benefit. I mean, once you contribute, your job is over. Yeah, and it should be charged to profit and loss unless until if these employees have worked for a construction of a PPE, development of an intangible, or construction of investment property, we will capitalize it with the respective asset. Otherwise, it will be charged to profit and loss as usual. And if it is payable within 12 months, as usual, I mean, no discounting. But if it is payable after 12 months, yes, it is obviously you are supposed to do the discounting concept. Okay, right. When it comes to defined benefit plans, yeah, this entire calculation we will be doing it in 6 steps totally. 6 steps. Step number 1, first we will estimate what will be the obligation that entity has to pay at the end, at the time of retirement. That is future value. Second thing is, we will calculate it in present value. We will calculate it, and we will follow one PUCM method, that is a projected unit credit method. Projected unit credit method. In simple words, it is SLM. In simple words, it is SLM. Okay, right. I mean, here there are two. I mean, first one, current service cost. Current service cost in the sense, this is the cost I am pay. We are payable to the employee because of the current year service in the company, not for the last year service. This is for the current year service. Then the journal entry will be current service cost account debit to provision for gratuity. Current service cost account debit to provision for gratuity. And year 2, I mean, next year what will happen? Obviously, this is you provided today payable provision for gratuity or payable, you said it, but the payment will be happening after 5 years or 6 years when he leaves the employment, correct? So e provision is supposed to be unwinded in the sense, that is what next year what will happen? In second year, current service cost account debit, interest cost account debit to provision for gratuity. This interest is nothing but unwinding cost. Again, as I said, in the standard, even though we say interest cost is part and parcel of employee benefit expenses. Remember, it is part and parcel of employee benefit expenses. Step number 3, that is determination of fair value of plan assets. Yeah, see, plan assets are always measured at fair value. Plan assets are always measured at fair value on the balance sheet date. Okay, right. So when I say it is measured at always, right. See, when do you say it is a plan assets? When the company is contributing to one fund or a trust, correct? Na? I mean, company does, that is a separate legal entity. The first point, company cannot get back the money under the worst circumstance, that means on account of liquidation also, company cannot, I mean liquidator cannot touch that gratuity amount, the gratuity trust amount. Under that circumstance, then we say we have contributed to a plan assets word will be used, right? So this will be right when you contribute to the plan asset. What is the journal entry? Plan asset account debit to cash. Okay, when the employee retired and if he takes the money from the plan asset will recognize as a cash out, but employer, because money is withdrawn from the plan asset, not from me. That's why what are we supposed to do? Our liability reduced because employee is out. That's why provision for gratuity account debit to plan assets, you are supposed to record it, because my plan assets amount reduced, at the same time my liability also is reduced, right? And the next point is the next point what I would like to say, plan assets may be growing, correct? Plan assets will be increasing, right? That return from the plan asset is going to be divided into two. One is expected return and the other return, I will say, that is beyond expectation. If it is expected return, that will be transferred to P&L. If the return, suppose say, I mean opening balance of plan assets is equal to 1 lakh. Opening balance of plan assets is equal to 1 lakh. I am expecting 10%. That means 10,000 rupees. E 10,000 should go to P&L. Okay, this should be offset with the above interest cost. Yeah, suppose the company that fund earned more than 10,000 rupees. More than 10,000 means say 12,000 rupees you earned. 2,000 rupees will be transferred to OCI. Why, sir? Means that is beyond expected return is called as actual gain or loss. In my example, it is actual gain because you got more amount of returns. It is called actual gain. That will be transferred to OCI. Okay, right. Next, that is fourth topic only, actual gain or loss. Actual gain or loss, that is because of the estimations. The estimation mistake can happen in two ways. One is from the plan asset side, I can say. The other one I can say, I mean estimation changes in the liability side, correct? So when the liability side, that means I may be expecting employee salary will grow by 10%, but actual growth may be 11%. Then that is actual gain or loss we will call. That actual gain or loss is supposed to be transferred to OCI. It is supposed to be transferred to OCI. OCI in the sense it will be directly transferred to retained earnings. But it will be presented in the OCI. It will be added to the retained earnings in the statement of changes in equity. Okay, right. That is step number 4. Next, when it comes to balance sheet presentation, what do we do first? First we'll say provision for gratuity minus fair market value of the plan asset. The net number only will be presented. And net number can become an asset. Yes, if it is an asset, yes. If you, I mean you can present it as an asset in the balance sheet, but whichever is lower. One is the difference between the provision for gratuity minus present value of the plan assets, or the present value of the future economic benefits. Yeah, because some trust may restrict us to withdraw. So under that circumstance, what amount that I can withdraw in the future, that you bring it to present value, compare it, whichever is lower, that number only should be presented in the balance sheet as an asset. That number only will be presented as an asset in the balance sheet. Okay, right. Next point is step number 5 and 6. We should read it together, actually speaking. That is curtailment and past service cost also we will club it. Okay, past service cost in the sense very simple. Current year we made some change. Because of which what is happening? An employee who worked for us in the past years, he is becoming entitled in the current year because of the change in the plan. Remember, it is not a change in estimation, it is a change in the plan. Earlier, the example, assistant managers were not allowed for a plan, okay, for some benefit. Right now, suddenly company management took a decision. Now, assistant managers are also part and parcel of this plan. Correct. And who is eligible? Whoever completed 3 years of service. Right. Suppose there are 30 employees who already worked in the past and completed 3 years of services. It's vested for them. Whether it is vested or unvested, yet some benefit has to be given. That is not for the current year their work, current year service. That is for the past year service. So all that past service cost is supposed to be booked in the current year, because it is not a prior period error. It is a change in the plan. There is no restatement of financial statements. It should be recognized in the current year profit and loss straight away. Now come to the step number 6, that is curtailment. Curtailment or settlement. Curtailment in the sense we are closing the plan without any payment. Settlement in the sense we are closing the plan by making some payment, by making some payment, maybe lower money or higher money to the employees, and we'll close it. Remember, what are we supposed to do in case of curtailment or settlement? We have to remeasure as on the date of curtailment or settlement the fair market value of the plan assets and fair market value, present value of the obligation. You have to remeasure it. You have to remeasure it. When before curtailment once, immediately after curtailment once. That difference, right? Suppose 100 rupees is before curtailment. After curtailment it became 60. That means your liability came down by 40 rupees. Now, if you have paid 40 only exactly, then there is no gain, no loss. Suppose 40 reduced in the liability, but payment happened 50. Then 10 rupees is a loss, which will be transferred to profit and loss. Or sir, no, I paid only 30 rupees. That is a gain. Then that also will be transferred to profit and loss. That's it, my dear. This is topic number 4, post-employment benefits. Last topic, which is nothing. Topic number 3, which is other long-term employee benefits. When I say other long-term employee benefits, employee worked in the current year, but the payment will be happening after 12 months from the balance sheet date. After 12 months from the balance sheet date, then it is long-term employee benefit. Whatever the rules I taught with respect to post-employment benefits, all 6 steps are applicable to this long-term employee benefit also, except only one small change, that is the actuarial gain or losses with respect to post-employment will transfer it to OCI. But here in other long-term employee benefits, it will be transferred to profit and loss. That's all. Other than that, there is no difference. That's it, my dear. This is about your Ind AS 19 employee benefits. If you like the video, please subscribe and share it with your friends. Right. Thank you and wish you the very best.